Hello, 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 hello. So, hello, all my dear students of CA Final Full English. I hope you all are doing good. I hope your studies are going on great for your upcoming exams. So, today we are going to start with revision of one of the most important and one of the biggest topic of your CA Final Direct Tax, that is capital gains comprehensive revision. So, capital gains is a chapter which I will tell you well in advance. I have told you in the class also. This is a chapter which will come in question number 2 in the examination. A question of 8 to 10 marks might come from this chapter. Along with that, an MCQ can also come. So it's a topic which is of great importance for your examination. So let us start without wasting any further time. Comprehensive revision on the chapter of capital gains. The provisions of capital gains are given from section 45 to 55A. So these 11 sections covers the entire capital gains chapter. We all know that the first section of every head is generally a charging section. So here also the first section, that is section 45, is the charging section. Now in section 45 in capital gains there are two types of charging section. One is general charge, one is special charge. General charge is given under 45 subsection 1, and for special charging section there are many other subsections which we will see after some time. Now what does general charge has to say? General charge has to say four things. If four conditions are fulfilled, you will be covered under the general charging sections of capital gains, and you will be liable for tax as per the capital gains chapter. So what are you supposed to do? There has to be a capital asset. There has to be a capital asset. That capital asset you have to transfer. From transfer you should generate profits and gains. And then the profits and gains shall be chargeable in the previous year in which the transfer took place. So we need to understand the meaning of all these four terms one by one. Okay. So we will start with the first one. What do you mean by the term capital asset? The term capital asset is defined in section 2 clause 14 in two parts. Capital asset means something, capital asset excludes something. First we will see what does capital asset means, then we will see what does capital asset excludes. Capital asset means, point number 1, it means property of any kind held by an assessee whether or not connected to any business and profession. Any property which is held by you is a capital asset. Whether it is connected to business or not connected to business, it doesn't matter. The property can be tangible, intangible, movable, immovable, fixed, circulating. It can be any kind of property. Every property which is held by an assessee is a capital asset, irrespective of whether it is connected to business or not. Second point has 2 points. First, securities which is held by foreign institutional investors. If an FII is holding any security, that will always be called as stock in a capital asset. That will never be called as stock in trade. Even if they are regularly selling, it will not be called as stock in trade. It will always be called as what? As a capital asset only. Similarly, one more amendment has come in Finance Act 2025 that if a security is held by AIF, investment fund, which is covered under 115 UB. So if an alternative investment fund, AIF, is holding securities, that security will also be always called as what? As a capital asset. And last but not least, if you are holding a ULIP, which is not exempt under 1010D, if it is exempt, then obviously it is not taxable. But if it is not exempt under 1010D, then it is a capital asset. And if it is a capital asset, you are liable to pay capital gains. How to pay capital gains, that we will see later on in this chapter. So this is the means part of the definition of capital asset. Now let's go to the excludes part of the definition of capital asset. What does capital asset exclude, sir? Capital asset excludes first of all stock in trade. Why? Because stock in trade is covered under PGBP. So therefore you have to exclude stock in trade from the definition of capital asset. Second thing which is excluded from the definition of capital asset is something which is personal plus movable. Any item which is personal plus movable is excluded from the definition of capital asset. If any item is personal plus immovable, then it is a capital asset. If any item is movable plus business, then that is also a capital asset. But always remember, personal movable items are excluded from the definition of capital asset, but 6 items will always be capital asset irrespective of whether they are personal movable or not. Even though they are personal movable, 6 items will always be capital asset. First, painting. Second, jewelry. Third, drawing. Fourth, archaeological collection. Fifth, any other work of art. And sixth is sculptures. You can see those 6 items over here. These 6 items will always be called as capital asset, irrespective of whether they are personal movable or not. It doesn't matter. Okay. Then come to third point, third exclusion. If you have a rural plus agricultural land plus in India, if land has to be rural, the land has to be agricultural, and the land has to be in India. Sir, what do you mean by rural land? Rural land means a land which is located in a city or in a district whose population as per the last census in 2011 is less than 10,000 people. So any area, any district or any cantonment board whose population as per the last census is less than 10,000, that area will be called as what? As a rural area. The moment that area will be called as rural area, in that rural area, if there is an agricultural land in India, if you sell that, it is not subject to tax. Now, few more things. It means if the population is 10,000 or more, it will be called as urban area. Yes. So if the population is 10,000 or more, it will be called as urban area. Now, in this also there is a catch. If the population is 10,000 or more, but up to 1 lakh, then that area will be urban, plus 2 kilometer land adjacent to that area will also be called as urban. Second, if the population is more than 1 lakh but up to 10 lakh, then that area will be called as urban, and 6 kilometer land adjacent to that area will also be called as urban. And if the population is more than 10 lakh, then that area will be called as urban, and the 8 kilometer land up to that area will also be called as what? Urban. This is what it is given over here. Now, next exclusion. There are some gold deposit bonds which are excluded by the government. And one last thing, deposit certificate under gold monetization scheme is also exempt. Sir, what is this deposit certificate? You have a physical gold, you give the physical gold and take a fixed deposit type of certificate. On that, they will also give you interest. That interest is also exempt, and capital gains is also exempt. No capital gains, no interest tax, no IFOS. Both are tax. Both are subject to exemption. Now, there are some issues over here which I need to address. First, silver utensils are not subject to tax. Silver utensils are not capital asset. But yes, gold utensils are definitely capital asset. Further, if you buy some souvenir, etc., for puja, etc., for worshipping God, if you buy some souvenir, then those souvenir which is of gold or silver, etc., then that are subject to tax. Those will be subject to tax. So this is what the definition of capital asset is all about. Now we will go ahead with the second part. What do you mean by profits and gains? The profits and gains for the purpose of section 45 subsection 1 has to be real profit. What kind of profit? Real profit. If you want to charge profit under 45(1), the profit has to be real profit. Real profit means what? The real profit means the profit has to be, the selling price must be actual. The selling price should not be FMV or notional. If you want to take selling price as an FMV or notional amount, then you need to make a separate charging section like 45(2), etc. Selling price 45(2), 45(5), etc., where the selling price is notional, not actual. Special charging section has to be made. Then last point over here, then we will go ahead with the definition of transfer. Suppose I bought a land 20 years back, and 1 year back I made a building on that land. Now I am selling that land and building both. The land was bought 20 years back, but the building was made 1 year back. Now I am selling the entire consolidated structure. So whether that structure will be called as long term or short term. For that purpose, you have to segregate the consideration between land and building separately. Once you segregate the building construction, the building sale consideration will be subject to short-term capital gains because it was constructed 1 year back, and the land capital gains will be subject to long-term capital gains because it was constructed long back. I hope it is clear to all of you. Now we will talk about the definition of what? Transfer. What is transfer? To tax capital gains, you need to transfer a capital asset. So definition of transfer is given in section 2, clause 47. Sir, what is transfer? Transfer includes sale. Transfer includes exchange. Transfer includes relinquishment. Sir, what is relinquishment? Relinquishment means to give up something. When you give up something, that is called as relinquishment. Transfer includes extinguishment. Extinguishment means something which is ceased to exist now. Something which is ceased to exist at your end. That is called as extinguishment. Then transfer includes compulsory acquisition. If any asset is compulsorily acquired, that is also a transfer. Then transfer includes conversion of a capital asset into stock in trade. If a capital asset is converted into stock in trade, then that is also transfer. Then in case of immovable property, the date of possession is considered as date of transfer. Date of possession is the most important date for the purpose of capital gains computation. Then, in case of immovable property, I have told you in the class, in case of a cooperative society, all the flats are owned by the society, and the owner only is a shareholder who has the right to transfer the enjoyment of the property. So if you transfer any enjoyment of property, then that is also what? A transfer. It is written over here, and it is also written in this Supreme Court judgment. This judgment also talks about that only. That if you transfer the right to enjoy any property, then that is also considered to be a transfer as per the Supreme Court judgment of Cheshire Steels Private Limited, 2020. And last but not least, if you do mature or redeem your zero coupon bond, then that is also a transfer. Transfer of zero coupon bond is subject to capital gain tax. Now, there is one more issue over here, that if there is a reduction in the share capital by a company, the share capital of the company is reducing, but without changing the shareholding pattern nor changing the face value of the shares. The face value of the shares remains at 10 and the pattern of the shareholding is same, 30%, 30%, 20%, 20%. But the overall shareholding has fallen. Whether that is a transfer? The answer is yes. That is also a transfer. If the overall shareholding pattern doesn't change and the face value doesn't change, but the shareholding reduces, that is also a transfer in the eyes of the law. As per the Supreme Court judgment, very recent important judgment, it is a PCID and another versus Jupiter Capital Private Limited, 2025. I hope it is clear to all of you. Now, once we know that what is subject to tax under 45(1), so now we will go ahead with the computation of capital gains. Now, all the capital gains are computed under two sections, either under section 48 or under section 50. Section 48 talks about computation in case of other than block, and section 50 talks about computation in case of block of asset. If you are transferring a block of asset, then section 50 is applicable. If you are transferring other than block, then section 48 is applicable. I am not interested in capital gains of block of asset as of now. I am interested in capital gains other than block as of now. So we all know how the computation statement is made. Full value of consideration minus expense on transfer, cost of acquisition, cost of improvement, and this last point we will see after some time when we will do partnership firm provisions. Now, here I would like to say one thing. We are learning right now only other than block capital gains. Block capital gains we will see later on after 20-30 pages. Now, coming to this particular box. Suppose you have bought a house property on loan. You have taken a house property on loan. And on that loan, you have paid a lot of interest. And you have already claimed deduction of that interest under Chapter 6A, under 80EE, under 80EEA, or under house property under Section 24. So if you have already taken a loan on house property and you have already claimed deduction under Chapter 6A or under Section 24, that interest cannot form part of your cost of acquisition or cost of improvement. That interest cannot be claimed as what? Cost of acquisition and cost of improvement ever. I hope it is clear to all of you. Now we will talk about when an asset can be called as short-term and long-term. The definition of short-term capital asset is given under Section 2, Clause 42A. And the definition of long-term capital asset is given under Section 229A. Long-term capital asset is very simple. Long-term is something which is not short-term. Short-term capital asset is a very long definition. So when an asset can be called as short-term? If the period of holding is up to 24 months. If the period of holding is up to 24 months, it is called as short-term. Sir, how to compute period of holding? From date of purchase till 1 day prior to date of transfer. You will count from the date of purchase till 1 day before the date of transfer. You have to consider, that is considered to be the period of holding. If it is up to 24 months, it is short term. If it is more than 24 months, it is long term. But there are some assets which will become long term after 12 months itself. Let's see which are those fortunate assets which will become long term after 12 months. First, listed securities. Listed securities, which will include listed shares, listed debenture, listed bond, listed government security, listed units, units of business trust, units of AIF, units of securitization trust, derivatives. All these things, if these are listed, they will become long term after 12 months. Up to 12 months, they are short term. Above 12 months, they are long term. You all can comment below if you are understanding everything very nicely, please. Second, units of UTI and equity oriented fund, whether they are listed or unlisted, they will become long term after 12 months only. For units of UTI and equity oriented fund, they will become long term after 12 months, irrespective of they are listed or unlisted. And last but not least, zero coupon bond, listed or unlisted, they will become long term after 12 months. Apart from this, all other assets will become long term after 24 months. But there is one asset which even today becomes long term after 36 months, and that is slum sale. If you are transferring an asset in slum sale, then that will become long term after 36 months, not after what? Not after 24 months. I hope it is clear to all of you. Now we will talk about first proviso to 48, which is very important for your examination, which is based on non-resident taxation. What is first proviso to 48? To whom first proviso to 48 is applicable? First proviso to 48 is applicable to a non-resident or foreign company. What are they doing? They are buying shares or debentures or bonds of Indian company. What are they doing? Non-resident or foreign company are buying shares and debentures or bonds of Indian company. Indian company, whether that will cover government company also? Yes. Bonds, shares, etc. of government companies are also covered. Whether government is covered? No. Government is not covered. Government is not covered. RBI is not covered. RBI bonds, government bonds are not covered in this particular section. It has to be an Indian company. Okay. Government company is okay. Indian company, government company is also Indian company only. Now, they should purchase the shares in foreign currency. If they purchase the shares in foreign currency, then their calculation will be made as per Rule 115A. What does Rule 115A says that? Sale consideration and expense on transfer has to be converted into foreign currency. First, you will compute as per INR, then you convert into foreign currency. It should be both of them should be converted into foreign currency as per average of TTBR and TTSR on the date of transfer. Average of TTBR and TTSR you should take for sale and expense on transfer. Now coming to cost of acquisition. For cost of acquisition, you have to take average of TTBR and TTSR, but now on the date of purchase. What will you do? Now you will take date of purchase. Now after that you will get your capital gains in foreign currency. Now you have to reconvert that capital gains into INR. While reconverting into INR, now you will not take average. Now you will only take TTBR, telegraphic transfer buying rate, which is your SBI, State Bank of India's rate. TTBR on the date of transfer, and you will get this. And you will do this particular exercise again and again. Even for reinvestment also, you are going to do this exercise. I hope it is clear to all of you. Whenever you will reinvest in India, that time also you will do this exercise only. I hope it is clear. This proviso is not applicable for equity shares which are covered in 112A. If your shares are covered in 112A on which you have paid STT, etc., then in that case you don't have to follow first proviso to 48. I hope it is clear. Let's move ahead to the second proviso to 48. The story of second proviso to 48 is almost close from 23rd of July 2024. What is second proviso to 48? Second proviso to 48 is nothing but your indexation. Now, indexation of the current year is 376. Okay. Current year indexation, you have to remember, rest they will give it in the exam in the form of table. You don't have to remember all those things. It starts from 2001, 2002. Now, what is indexation? Indexation is nothing but increase in the cost due to inflation. But from 23rd July 2024, you do not get indexation in any case except one case. Only one case you will get indexation. No other case you are going to get the indexation. We'll talk about that one case in a while. Before that, we will talk about little bit about indexation also. Indexation, how to find out indexation? Index cost of acquisition is nothing but cost of acquisition into cost inflation index of the year of transfer divided by the cost inflation index in the year in which you have first acquired the asset, or 2001-2, that is if you have purchased before 2001. Index cost of improvement is also same thing. Now, if an asset is acquired before 2001, we all know that if you acquire an asset before 2001, what to do? In that case, your cost will be actual cost, or FMV is on 1 for 2001, whichever is higher. If it is acquired before 2001. Separately, we will do the discussion of what is cost of acquisition separately in next 5 minutes. If an improvement is done before 2001, then you will not get the deduction of the improvement. Improvement cost of improvement is only allowed if it is done on or after 1st April 2001. Any improvement done before 2001 is not subject to deduction. I hope it is clear to all of you. Next one, I will just keep it on hold for some time. I will discuss in today's session only, don't worry. Next point, I will discuss point number 2. The deduction of STT is not available under the income tax law. What do you mean by this? That the deduction of STT is not available. I mean, if you pay STT on purchase, you should not add to the cost of acquisition. And if you pay STT on sale, then you should not reduce from the full value of consideration. This is what I mean when I say the deduction of STT is not available. STT is not available under the income tax law. I hope it is clear to all of you. Now, from 23rd July 2024, we do not get indexation anywhere, but only one place they have given us what? They have given us an option. That is, if you are a resident individual in HUF, you need to be resident, or you need to be along with resident, you need to be individual or HUF. Second, you need to transfer land, building, or both, any kind of land, any kind of building, residential, commercial, or agriculture, any kind of land and building. Residential, commercial, that doesn't matter. The property has to be land or building. You need to transfer land on building. Plus, the land and building should be purchased before 23rd July, and it has to be transferred on or after 23rd July. If these four conditions are fulfilled, the law is giving you two options. Option one will always be 12.5% without indexation. This is the by default option from 23rd July 2024. From 23rd July 2024, everybody has to follow this option only, 12.5% without indexation. But only for this case, you have one more option. That is, you can take 20% tax with indexation also, and whichever is more beneficial, whichever tax is less, you can pay that. But always remember, in option 2, if there is a loss, then that loss will not be allowed to carry forward and set off. In option 2, if there is a loss, we will not allow you to carry forward and set off the losses in option 2. I hope it is clear to all of you. Now coming to one landmark judgment of BC Srinivasa Setty, what has happened in this case, and based on this, then we will see the definition of cost of acquisition. What has happened in BC Srinivasa Setty, sir? The assessee has sold his business. While selling his business, he also sold his self-generated goodwill. While selling the self-generated goodwill, the assessee said that the cost of acquisition of the self-generated goodwill is not applicable, but the department is saying it is nil. Assessee asked where it is written nil. It was nowhere written at that time that it was nil. Therefore, the Supreme Court said that it is not nil because it is not mentioned in the definition of cost of acquisition. Therefore, it is not applicable, and sale consideration minus cost of acquisition not applicable is not determinable. And therefore, the Supreme Court gave a landmark judgment that whenever computation mechanism fails, the charging section cannot be applied. Whenever computation mechanism fails, the charging section cannot be applied on the assessee. Therefore, after that, the Government of India made amendment in the definition of cost of acquisition in section 55, and they said that the goodwill of a business or profession or trademark or brand name associated with business and profession or any other intangible asset or a right to manufacture, produce, process any article or thing, or right to carry on any business and profession, or tenancy right, or stage carriage permit, or loom hours, or any other right. All these are nothing but, you can write it down if you have not written, I have told you in the class to write. All these are nothing but intangible assets. All these things, if these are self-generated, then the cost of acquisition should be nil, nil, nil. Now they have written the word nil, so now this judgment is not relevant for us. Okay, this judgment is not relevant for us as of now. Therefore, if it is self-generated, you have to take as nil. But if it is purchased, you have to take that as a purchase price. If you have purchased the goodwill from someone and then you are selling it, then you will take purchase price as your what? As your cost of acquisition. Now, one bad news for all these items. The bad news for all these items is, in all these items, even if it is purchased before 2001 or it is generated before 2001, the option to take FMBS on 1/4/2001 is not available. There are two places under income tax law where option to take FMBS on 1/4/2001 is not available. One is this, one will come later on in this chapter in the case of conversion of an AOP BOI stock exchange into a company. That time also we will see that. Okay, I hope it is clear to all of you. Point number 2. What is the cost of acquisition of bonus shares, sir? The cost of acquisition of bonus shares is generally nil. But if the bonus share is allotted before 2001, then the cost of acquisition of the bonus share will be what? The FMB on 1/4/2001. Therefore, the cost of acquisition of bonus share is nil only if the shares and units are allotted on or after 1st April 2001. If it is allotted before 2001, then the cost will become what? The FMB on 1st April 2001. Next, what is the cost of acquisition in case of right shares? Let's take an example. I am a shareholder of a company and the company has offered me a right of buying 10,000 shares. I said that company, I don't want the right, I will renounce this right to my friend. So I renounced this right to my friend for 10,000 rupees. So I took 10,000 rupees from him and I renounced this right to him. I told him that you purchase the shares, I don't want to purchase the share. So when I renounce this right, this is also a transfer of capital asset. So how will I be subject to capital gains? FVC. FVC is the amount received on renouncement. Say 10,000 rupees is my FVC. Minus what is the cost of acquisition? The cost of acquisition of renouncing the right is nil, nil, nil. Therefore, entire 10,000 rupees will be subject to capital gains in my hand. Now, my friend has bought the right. What he will do? He will go to the company and purchase the shares. Now, he is going to the company and purchasing the shares for say 1 lakh rupees. So 1 lakh rupees he has paid to the company and 10,000 he has paid to me for buying the rights. Later on, whenever he will sell the shares, what will be the cost of acquisition for my friend? For my friend, the cost of acquisition will be 1.1 lakh. Why? Because he has two costs now. One, he has paid to me for buying the rights. One, he has paid to the company for buying the shares. For him, the cost of acquisition will be 1.1 lakh. This is what it is written over here. Then I am coming to point number 5. Then I will come back again to point number 4. Point number 5. In case of land and building, what is the cost of acquisition? See, if you have purchased the land and building before 2001, then you have to compare your FMV on 1/4/2001 with stamp duty value on 1/4/2001, whichever is lower. And then you will compare your actual cost, then you will say whichever is higher. So first you will compare FMV as on 1/4/2001 with stamp duty value as on 1/4/2001, whichever is lower. Then whatever is the lower amount, that you will compare with the actual amount, actual cost, purchase price, and then whichever is higher, that will become your actual cost. In case of any other asset, apart from these four assets, if it is acquired before 2001, any other asset apart from these four assets, if it is acquired before 2001, then the cost will be cost or FMV as on 1/4/2001, whichever is higher. And if it is acquired on or after 2001, then the cost will become the cost of acquisition, that is COA. I hope it is clear to all of you. Next, what is the cost of improvement, sir? See, in case of intangible asset, the cost of improvement will always be nil. In case of any other asset apart from intangible asset, if it is done on or after 2001, if it is done after 2001, then you can claim cost of improvement. But if it is done before 2001, then it should always be ignored. Any cost of improvement done before 2001 are not subject to deduction from full value of consideration. I hope it is clear to all of you. Now let's move ahead towards the next part. Special charging section. What are special charging section? As I have told you earlier, what is written in 45.1? What is written in 45.1 in the last line is the capital gain should be chargeable in the previous year in which transfer took place. Generally, the capital gain is chargeable in the year in which the transfer takes place. But there are 4 exceptions under the income tax law where capital gain will not be chargeable in the year of transfer, but it will be chargeable in future. Because it has to be deferred, otherwise it will be genuine hardship on the assessee, like in these 4 cases. So these are the 4 cases where capital gains will not be chargeable in the year of transfer, but it will be chargeable in future. First case is insurance claim received 45.1a. What is this, sir? If an asset is destroyed, suppose your asset is destroyed in 24-25 and the money or the asset from the insurance company is received in 25-26, then capital gains will be chargeable in the year of receipt, not in 24-25. So asset is destroyed in 24-25, but the insurance claim is received in 25-26. So therefore, the capital gains will be chargeable in 25-26. But the year of transfer will be 24-25 only. The period of holding will be determined till 24-25 to determine whether the asset is long term or short term. The period of holding will be determined till the year of destruction, till the date of destruction. And if the date of destruction is before 23rd July 2024, then you will also be eligible for indexation in that case, because everything depends upon date of transfer. Indexation depends upon date of transfer. So, year of chargeability is year of receipt. Year of transfer is year of destruction. As simple as that. Period of holding will be counted till year of destruction. Indexation will be counted till year of destruction if the destruction happens before 23rd July. After 23rd July, it is not possible, except in one case. Therefore, this is what this beautiful section is all about. Now, there are 2 small points in this which I need to address. Sir, my asset is destroyed, but it is not insured. If your asset is destroyed and if it is not insured, it is a capital loss. This section is not applicable. Sir, what do you mean by capital loss? Then capital loss means this loss does not have any treatment under the income tax law. You cannot set off this loss under the income tax law. This is what capital loss means. Sir, what if my asset is a part of block? If your asset is a part of block, then reduce from the block of asset. It is as simple as this. When to reduce on the block of asset? When you will receive the insurance claim money from the insurance company, at that time you can reduce it from the block of asset. So this is what this first exception is all about, where the chargeability is deferred to future. Second exception, conversion of capital asset into stock in trade. We have already seen in the definition of transfer, conversion of capital asset into stock in trade amounts to what? Amounts to transfer. So if you convert a capital asset into stock in trade, it is a transfer, but the charge of tax will not be now. The charge of tax will be year in which you will sell the SIT. Whenever you will sell the SIT in that year, you will be liable to pay tax under 2 heads, one under capital gains, one under PGBP. For example, in 2010, you purchased a jewelry. for 1 lakh rupees. In 2015, you converted that into a stock in trade. So 2015 will be the year of conversion. The 2015 will be considered as year of transfer. But you sold that stock in trade in 2025. So the PGBP as well as the capital gains will be chargeable in 2025. But the period of holding will be counted till 2015 only. The indexation will be taken till 2015 only. Because 2015 is the year of conversion and year of conversion is the date of transfer. Sir, how capital gains will be charged? Every capital gains as well as PGBP will be charged in the year of sale of SIT. First, capital gains will be FVC, FMV on the date of conversion. Whatever is the FMV of the asset on the date of conversion minus cost of acquisition or index cost of acquisition. Period of holding will be counted from date of purchase till the date of conversion. Sir, how SIT will be computed? PGBP will be computed. PGBP will be sale of SIT, sale price of SIT, at what price you are selling the stock in trade, minus whatever you have taken as FMV on the date of conversion, that will become the cost over here. That will become the cost for PGBP. So 5 lakhs, 10 lakhs, 20 lakhs. That 10 lakhs is the most important amount. 10 minus 5 is the capital gains. 20 minus 10 is your PGBP. As simple as that. 10 minus 5 can also be subject to indexation if it is long term. I hope it is clear. What if any part of SIT is sold? If part of SIT is sold, then capital gain will also be charged proportionately. It will not be charged completely. If you are not selling the complete SIT, suppose there are 10 flats which are converted from capital asset into stock in trade. Out of that, only 7 flats are sold. Therefore, only 70% capital gains will be subject to tax, not 100%. I hope it is clear to all of you. Now, let's talk about the reverse situation. When a SIT is converted into capital asset, let's take an example, reverse of above. Suppose this is 25-26, this is 28-29. Earlier, we bought one jewelry of 1 lakh rupees that is considered as SIT, stock in trade. Now, we are converting that SIT into capital asset. The fair market value of the SIT is 5 lakh rupees on conversion. Now, the law does not defer the tax. Now, the law says that when an SIT is converted into capital asset, you have to offer PGBP income tax today only. That is in the year of conversion. Now, it will not be deferred to year of sale. Today only you have to show 5 lakh as sale, 1 lakh as cost, 4 lakh offer as PGBP income under section 28. Later on, when you will sell the capital asset, that time you pay capital gains. The period of holding will be counted from the date of conversion. The cost of acquisition will also be the FMV on the date of conversion. 5 lakh will be counted as cost of acquisition for this capital asset, and the period of holding will also be counted from the date of conversion, as simple as that. Last but not least, what if this jewelry is a fixed asset? Suppose this is not a jewelry, this is a building. Earlier it was an SIT. Now you have converted that into capital asset. And now that capital asset building, you are using that as a fixed asset for the purpose of business. Will you claim depreciation? The answer is yes. So if I am converting a building, SIT, into a capital asset, now that capital asset is used as a fixed asset in the business. So I want to claim depreciation. So what should be the actual cost? That is given in explanation 18243.1. The FMV on the date of conversion will become the actual cost. And on that amount, on that FMV on the date of conversion, you can claim depreciation. Everything revolves around that 5 lakh rupees. Everything revolves around that. Everything. So this is our second exception. Let's go on to a third exception. I'm leaving some pages here. I'll come back to that in 10 minutes. The third exception where the capital gains is deferred to future. What is the third exception, sir? Compulsory acquisition. Capital gains on compulsory acquisition. Section 45, subsection 5. Suppose your property is compulsorily acquired by the government in 24-25. So that year will be considered as year of transfer. But that year will not be considered as year of taxability. Suppose the government has compulsorily acquired in 24-25 and they have decided the original compensation to be 5 lakhs. Now, when this 5 lakh will be taxable? In the year in which the entire original compensation or even part of the original compensation is received, the entire amount will be subject to tax. Suppose next year 25-26, out of 5 lakhs, if only 1 lakh is received now, then also entire 5 lakh will be chargeable. This is what the provision is. The original compensation will be chargeable in the year in which the part is also received. Even if the part of the original compensation is received, entire original compensation will be subject to tax in the year of receipt. This is the first point. Second thing, so I paid the tax on original compensation. Then I'm not happy with the compensation, so I filed a case in the court. The High Court said that give further enhanced compensation to the assessee. So I got another 3 lakh as enhanced compensation. When this enhanced compensation will be subject to tax? That will be subject to tax in the year in which it is received. Whenever it will be received, that enhanced compensation will be subject to tax. What will be the nature of this enhanced compensation? The nature of the enhanced compensation will depend upon the nature of what? Will depend upon the nature of the original compensation. If the original compensation is long term, then the enhanced compensation is also long term. And if the original compensation is short term, then the enhanced compensation is also short term. Then, suppose while fighting the case, if the assessee dies, he expires, he is dead, and if it is fought by the legal heir of the assessee, so what will happen in the hands of the legal heir of the assessee? In the hands of legal heir of the assessee also it is subject to tax, it is not subject to exemption. Legal heir will also have to pay the tax, there is no exemption over here. Sir, what is the cost of acquisition of enhanced compensation? Nil. Generally the cost of acquisition of enhanced compensation is zero. But if you have fought the case and you have incurred some legal expenses, you can reduce the legal expenses from enhanced compensation. Only legal expenses are allowed to be removed from enhanced compensation, no other expenses. Next, suppose now I won the case in High Court. Now suppose the government is not happy with the enhanced compensation. So they went to the Supreme Court. And now suppose the Supreme Court says that reduce the compensation. It was not 3 lakh. Enhanced compensation was not 3 lakh. It was only 1 lakh. So now as per point number 5, you have to reduce the compensation and the assessing officer will pass an order rectifying your order of 3 lakh rupees enhanced compensation, reducing within 4 years from the end of the financial year in which the order was passed by the court. So if the Supreme Court reduces the compensation, the assessing officer will pass an order within 4 months and reduce the compensation and pass a revised order. What if the Supreme Court further increases? If they further increases, obviously it will lead to further enhanced compensation and that enhanced compensation will be subject to further tax. Now next, in this entire process, if there is a delay in paying the compensation, the government also pays you interest on compensation. What is the treatment of the interest on compensation? The treatment of interest on compensation is, it is taxable in the year of receipt first of all. It is taxable under IFO secondly. And from this interest, you get a flat 50% deduction, standard deduction from this interest, irrespective of the amount. Even if the amount is 1 lakh, 2 lakh, 10 lakh, 50 lakh, 100 crore, 200 crore, whatever it is. Whatever is the amount, from that you will get flat 50% deduction. I hope it is clear to all of you. One last thing. Sometimes what happens when the court feels that the case will go on for years and years and years, so the court announces and tells the government that pay some amount to the assessee as an interim amount. The court passes an interim order and tells the government to pay some amount to the assessee. So any amount received in the process in pursuance of an interim order, what will happen with that? So the government has said that any amount received in pursuance of an interim order will not be taxable now. It will be taxable in the year in which the final order will be passed by the court. Whenever the court will pass the final order, in that year, the interim amount will be subject to tax. It will not be subject to tax today. Are you all recognizing and are able to recall each and everything? Please tell me. Let's move on to the fourth section over here, fourth exception, where tax is deferred to future. Now this fourth section, that is 45(5)(a), that is joint development agreement section, is different from the first three sections. In this section, it is only applicable to individual and HUF. It is not applicable to others. Fourth section is only applicable to individual and HUF. What is individual HUF doing? Individual HUF. I am an individual HUF. I have a land, I have a building. I am giving the possession of that land, building to a developer. And developer is giving me what? He is giving me some money and he is giving me some part in the new project. He is giving me some money and some part in the new project. So when it will be taxable? So the government has said that it will be taxable on the date on which the project is completed, either in full or part. If it is completed fully or if it is completed partly, in that year we are going to tax it. We are not going to tax it today. Okay. We will tax in the year in which it is fully completed or partly completed. So what is the entire process over here? I am individual HUF. I am giving you my land, my building, possession. In return, you are giving me some money and you will give me some part of in the new project. Suppose 10 flats you will give me. Okay. So now when this amount will be taxable? This amount will be taxable in the year in which I will receive that project. 10 flats. Whenever I will receive that 10 flats, that time it will be subject to tax. At that time, what will be the full value of consideration? The full value of consideration will include two things. First, money that he is paying me. Suppose 1 crore he is paying me as a money. Okay. How much? 1 crore as money plus 10 flats he is giving. Stamp duty value of the 10 flats. Suppose the stamp duty value of one flat on the date of completion is 10 crore. So the stamp duty value of 10 flat will come to 10 crore. Therefore, total will be 11 crore. So what is the consideration I am receiving? 1 crore money and 10 flats. Every flat stamp duty value is suppose 1 crore. Therefore, total consideration is 11 crore. 11 crore will become my FPC. I hope it is clear to all of you. From that, I will reduce my cost of acquisition and compute capital gains. Later on, when I will sell these 10 flats, what will be the cost of these 10 flats? The cost of these 10 flats will be 11 crore rupees. Don't take 10 crore. Take the entire FVC. It is written in section 49. The cost of these 10 flats will be entire FVC. FVC as derived above. Whatever is the FVC, that will become the cost later on in future. Don't take what? Again, I am saying. Don't take what? Don't take 10 crore. Only the cost of flat. Take the entire consideration as your cost. Now, this deferral is only available. The amount, the tax is deferred till when? The tax is deferred till the completion of the project in full or part. Now, this deferral is only done for those people who are ready to take the project. Suppose I gave my land and building to the builder, to the developer, and builder told me 5 years. Now, after 2 years, I cannot wait. So, I am selling my rights to my friend and taking the money. And I am telling him, you take the flat from the builder, I don't want. In that case, if I am exiting the market in between and taking the money, in that case, I'll be liable to pay tax now only. In that case, deferral will not be allowed. And last but not least, the builder is giving you two things. One money, one flat, one monetary, one non-monetary consideration. So on money portion, on monetary consideration, the builder will deduct TDS at the rate of 10% or on payment or credit, whichever is earlier, if the assessee is resident. Under which section? Under 194 IC, and there is no threshold for deducting TDS. There is no threshold over here for deducting TDS. So the builder will deduct TDS if the assessee is resident at the rate of 10%. When at the time of payment of credit, whichever is earlier. I hope it is clear to all of you. So these are the 4 cases where capital gains will be subject to tax in future when you will receive the consideration, not in the year of transfer. I hope it is clear. Now coming back to some dangerous provision, page number 17.7. Section 45.3. What is 45.3? When a partner gives something, transfer something to the firm, the partner will be liable for capital gains. Or when a member of an AOP BOI transfers something to the AOP BOI, the member of the AOP BOI will be liable to capital gains. So what will be the full value of consideration in the hands of partner? It will be the amount recorded in the books of accounts by the firm. Whatever is the amount recorded in the books by the firm, that will become the full value of consideration for the partner for the purpose of this section. So suppose the partner is giving the firm, is transferring the firm, what? Say partner is transferring the firm some jewelry as a capital contribution. So the partner will be liable to tax as per 45.3. So what will be the cost of, what will be the FVC for the partner? It will be the amount recorded of that jewelry in the firm. I hope it is clear. Now coming to some dangerous provision, which is slightly difficult to explain without the help of those 3 CBDT big circulars, which we have done in our regular batch, exam oriented batch, and even we have done it in our practical question batch. But still I will try to explain to the extent it is possible from my side. That is section 9B and section 45.4. First we will talk about 9B. 9B is applicable on dissolution or reconstitution of the firm. Sir, what is reconstitution of the firm? First of all, we need to understand the definition of reconstitution of the firm. Reconstitution of the firm means when one or more partners ceases the firm. They leave, they retire. Or if one or more partners are admitted in the firm. Or nobody is retiring, nobody is admitting, only the PSR of the firm is changing. Only the profit sharing ratio of the firm is changing. Nobody is retiring, nobody is coming. So that is called as what? That is called as reconstitution. Reconstitution means some kind of change. One is retiring, one is admitting, or there is change in PSR. Now, so if there is a reconstitution or dissolution. Now, in this entire example, I will be firm, you will be partner, I will be firm, you will be partner. Please keep this thing in your mind. And the entire taxability is in the hands of firm, not in the hands of partner. Partner has nothing to do in this chapter, in this section. So I am a firm, you are a partner, and I am giving you on dissolution or on reconstitution. There is a dissolution or there is a reconstitution, and I am giving you capital asset or stock in trade. Why I am giving you capital asset stock in trade? Because there is a dissolution or reconstitution. then it is deemed to have been transferred by the firm to the partner. And the firm is liable to pay tax under capital gains or PGBP. For stock in trade transfer, PGBP. For capital asset transfer, capital gains. So what will be the FVC, sir? What will be the consideration? The consideration will be FMV of the capital asset, or SIT will be considered as full value of consideration. So for SIT, I will take the FMV, and for capital asset also I will take FMV. SIT will be subject to tax under PGBP, and capital gains will be subject, and capital asset will be subject to tax in capital gains. As simple as that. So what is the firm transferring? The firm is transferring capital asset or stock in trade. Why the firm is transferring? On dissolution or reconstitution. Who is liable to tax? Firm is liable to tax. What is the FVC? That I have told you, FMV. Now coming to 45(4). In 45(4) also I am firm, you are partner, I am firm, you are partner, I am firm, you are partner. Again I am giving you something. Why? Because there is a reconstitution. In 45(4) there is only reconstitution. In 45(4) there is no dissolution. Secondly, in 45(4) I am giving you money. In 9B I was not giving you money. In 45(4) I am giving you capital asset also. In 9B I was also giving you capital asset. So what is common in both the section? Capital asset. What is uncommon in both the section? Here it is money, then it is SIT. Now, how much capital gains will be chargeable in the hands of firm? Firm will be liable to capital gains with the formula, that is A is equal to B plus C minus D. Now, what is B? B is nothing but A is your answer. A is your answer. B plus C minus D is your computation mechanism. What is B, sir? B is the money received by the partner. There are two things you are giving in this section, money and capital asset. C is the FMV of the capital asset. And D is the balance in the partner's capital account. Whatever is the balance in the partner's capital account, whichever partner is retiring, etc., that partner's capital account you have to take. Now, while taking this B plus C minus D, if the answer is coming to negative, then take it 0. If B plus C minus D is coming negative, it can come negative also, then take it 0. Okay, I hope it is clear. Similarly, while taking the balance in the capital account in point number D, do not take increase in the capital account due to revaluation. Don't take any revaluation. Don't take any self-generated goodwill. Don't take any other self-generated asset. Don't take that. Then whether 9B and 45(4) both will operate together? Yes. CBDT has issued a circular. Both will operate together. First 9B will operate and then 45(4) will operate. First you compute as per 9B and then you come to 45(4). Now the most important point over here is point number D. How to compute D? Don't take D directly. You have to do one exercise which CBDT has said in the circular, if you remember. First, you compute capital gains and PGBP as per 9B. Have you done that? Done. Find out the tax as per 9B. Find out the tax as per 9B. Then, you increase the accounting profit. Whatever asset you are giving to the partners now, whatever asset you are giving to the partner who is leaving, that much asset you are supposed, that much profit you have to increase if you have revalued that asset. Whatever is the revalued profit. In our example, in a book, if you remember, we were giving the book value of the land was 10 lakh and we were issuing the land to the partner at 50 lakh. Therefore, 40 lakh was increase in the accounting profit. So, increase your accounting profit by 40 lakhs. From that, reduce the taxes paid under 9B. Whatever is the profit left, then that divide between all the three partners, and then that you have to take in point number D. Be very careful. While doing D, do not take D directly. First, increase the accounting profit, reduce the taxes as per 9B, whatever amount is left, that segregate between all the partners, and then compute point number D. I hope it is clear. Now, there are two important things that we need to say. Sir, is there not duplication of tax? Yes, there is a duplication of tax. Don't worry. So, what should we do in case of duplication of tax, sir? Whatever profit is coming in 45(4), that will be attributed to the remaining assets. In what ratio, sir? In the ratio of revaluation. Suppose there are three land. Land A, land B, land C. Land A you have distributed. All the three lands are revalued by 60 lakhs, 60 lakhs, 60 lakhs. So you are revaluing all the land by 1:1:1. So whatever 45(4) is coming, whatever 45(4) capital gains is coming, you will attribute to the remaining land which is not distributed to the partners. What is the use of attributing to the remaining land? The use of attributing to the remaining land is whenever those remaining land will be sold by the partnership firm, at that time they will reduce from their full value of consideration. In future, they will get the tax benefit. So whatever is the amount of capital gains charged under 45(4), that you have to attribute to the remaining assets of the firm. and the remaining assets of the firm will use that as a reduction from FPC in future date. I hope it is clear to all of you. Last but not least, sir, what is the nature of this gain under 45(4)? The nature of this gain depends upon to whom you are attributing. If you are attributing this gain to long-term capital asset, then this nature is also long-term. If you are attributing this to a short-term capital asset, then this nature is also short-term. If you are attributing this to block of asset, then this nature is also short-term. If you are attributing this to what? Self-generated asset or self-generated goodwill, then this nature is also short-term. So if you are attributing to short-term capital asset or block of asset or self-generated assets or self-generated goodwill, then the nature will be short-term, otherwise it will be long-term. More importantly, you have to see those three examples which I have explained you in great detail in the class. You can go and check over there. Let's move on to the next point. If there is a dissolution of the firm, then how the inventory will be valued? In case of dissolution, the inventory will be valued as per net realizable value, that is NRV, irrespective of whether the business is continued or not. Even if the business is continued by some other partners, then also it will be valued at NRV, and if it is discontinued, then also it will be valued at NRV only. I hope it is clear to all of you. Now let's go ahead with the next point, treatment of ULIP, unit linked insurance policy, and life insurance policy. To understand the taxability of ULIP and life insurance policy, first of all, you need to understand the percentage criteria. This percentage criteria is mandatory to understand at many places. If the policy is issued between 2003 to 2012, then your annual premium should be up to 20% of sum assured. If the policy is issued between 2012 to 13, then your annual premium should be up to 10% of sum assured. And if the policy is issued after 1st April 2013, then for normal person it should be up to 10% of sum assured, and for disabled person it should be up to 15% of sum assured. You need to remember these percentages first. Now we will talk about treatment of ULIP, unit linked insurance policy. If it is issued till 31st Jan 2021, then the treatment is different, and if it is issued on or after 1st February 2021, then the treatment is different. Now let's talk about old provision first. If it is issued till 31st Jan 2021, then you have to only fulfill percentage criteria. Only this percentage criteria has to be fulfilled. If this percentage criteria is fulfilled, your capital gains is exempt. But if it is crossing, if the percentage criteria is crossing, then you have to pay capital gain tax. How capital gain tax will be computed, that I will show in a while. But from 1st of February 2021, you have to fulfill two conditions if you want to make your ULIP exempt. First, you have to fulfill the percentage criteria, and then second criteria, if the policy is issued on or after 1st February 2021, your aggregate annual premium should be up to 2.5 lakhs of all the policies. If you violate any of the condition, then you will be liable for capital gains. How, sir? It will be taxed under 112A. In all the cases, it will be taxed under 112A at the rate of 12.5% in excess of 1.25 lakhs. In excess of 1.25 lakhs, it will be subject to tax. How much amount will be subject to tax? Whatever amount is received by you minus total premium paid by the company. Total premium paid by the assessee. You have received 30 lakh rupees and you have paid a premium of 25 lakhs, so 5 lakh will be subject to tax. So the rule is very simple. If the policy is issued before 1st February 2021, you have to fulfill only amount percentage criteria, and if the policy is issued on or after 1st February 2021, you have to fulfill the percentage criteria as well as the amount criteria. Amount criteria should also be fulfilled by the assessee. Now regarding this amount criteria, I have to say a few things. They have said the aggregate annual premium should not exceed 2.5 lakhs. So if you have more than one policy, so if you have three policies, the premium of all three policies 1 lakh, 1 lakh, 1 lakh, then you have to choose any two out of the three which you can make exempt. You cannot make exempt all three of them, because if you make exempt all three of them, the aggregate premium will exceed 2.5 lakhs. So if there are multiple policies, you have to select all of them out of them, and you have to make a combination of all those policies whose aggregate premium is up to 2.5 lakhs. That much you can exempt, rest you can offer for tax. I hope it is clear to all of you. Now what is the treatment of life insurance? For life insurance also there is a cutoff. If it is issued till 31st March 2023, and if it is issued from 1st April 2023, then the treatment is different. Till 31st March 2023, the treatment was different, and from 1st April 2023, the treatment is different. If it is issued till 31st March 2023, and if you want to make your life insurance exempt, you have to just fulfill percentage criteria. If percentage criteria is fulfilled, it is exempt, or else it is taxable. But from 1st of April 2023, you have to fulfill again two conditions. First, percentage criteria, and then amount criteria. And now the aggregate premium should not exceed 5 lakh rupees. Here the aggregate premium is not 4 lakh, is not 2.5 lakh. Here the aggregate premium is doubled, it is 5 lakh rupees. If you violate percentage or amount criteria, whatever it is, you will be liable to tax under IFOS under 56(2)(13). How much amount will be liable for tax? Here IFOS is there, in ULIP it is capital gains, but here it is IFOS. In ULIP there is a unit. There is a unit, so unit is a capital asset. So there you can charge capital gains. Here there is no capital asset. Here there is just a policy. Therefore here it will be chargeable under IFOS. How much IFOS? Whatever amount is received by the assessee, including the bonus amount, minus, most important thing, minus total premium paid for which deduction is not claimed earlier. It means you can reduce from here only that much premium for which you have not claimed deduction earlier under ATC. If you have claimed deduction under ATC, you cannot reduce this from here. I hope it is clear to all of you. Such provision was not there for ULIP. For ULIP, such provision was not there. But for life insurance policy, such policy is there. Here also, aggregate premium should not exceed 5 lakhs. If you have more than one policy, if you have 5-6 policy, aggregate all of them, the aggregate premium should be up to 5 lakhs. That much policies will be exempt. Rest of the policies will be subject to tax. Now, there are some common points to both of them. First point, I've already told you, you can check it. Second one, if you receive the money on death, then it is always exempt irrespective of the percentage and the amount criteria. On death, it is fully exempt. If it is received on death of the assessee, to the nominee, to the family members, then whether the percentage criteria is violated or the amount criteria is violated, it is always exempt. Next, Keyman insurance policy is always taxable. That is not subject to exemption. Next, when you check the premium of 2.5 lakh for ULIP and 5 lakh for life insurance policy, you should check excluding GST. Even though from September or August 2025 onwards, GST is exempted from the premium on life insurance and medical premium. But still, in the question, if they give you, you have to check the 2.5 lakh limit excluding the premium amount, excluding the GST amount. Suppose 2,40,000 is the annual premium, and including GST it is 2,60,000. So you don't check 2,60,000, you check 2,40,000. I hope it is clear. Now, one amendment and one relaxation. Amount criteria is not applicable for LIC. If you purchase the policy from an insurance office which is located in IFSC. So if I go to IFSC, Gujarat, International Financial Service Center, there I go and purchase what? A life insurance policy, then amount criteria is not applicable. Percentage criteria is applicable even there also. Percentage criteria is applicable. Amount criteria they have exempted in that particular place. Now a small section is there, not great as such. Let me talk about that section first, and then we will go ahead with some more important provision. Reference to valuation officer. If the AO wants, he can refer the matter to valuation officer to value certain things, where he finds that your valuation as per your registered valuer is at variance with the FMV. Assessee might have done some valuation of their assets. Assessee might have computed the FMV as on 1/4/2001. But the assessing officer feels that, he is of the opinion that this is at variance with FMV. So he can refer the matter to valuation officer. He can refer the matter to valuation officer in many other cases, like where he is of the opinion that the difference is more than 15% or the difference is more than 25,000, whichever is lower, or in any other circumstances or cases where it is necessary so to do. So wherever it is necessary for the assessing officer, he can refer the matter to what? To valuation officer. I hope it is clear to all of you. Okay. So here I will take a break for 2-3 minutes at least, because my throat is going. 2-3 minutes break we will take. After that we will start. So let's go ahead with the next part, which is very important part, that is 50C. 50C we are going to do now. What is 50C, sir? 50C talks about capital gains. Capital gains in case of what? In case of transfer of land and building, that is immovable property. If you transfer land and building, how will you compute capital gains? How will you compute FVC? The FVC will be the actual sale consideration or stamp duty value, whichever is higher. But you will take this only if the difference is more than 110%. So if the difference is more than 110%, you will take whichever is higher. Suppose selling price is 100 lakhs and if the stamp duty value is 150 lakhs. Now the difference is more than 110%. Therefore, you will take SDV as your full value of consideration, 150 lakh as your full value of consideration. Okay. I hope it is clear to all of you. Now, sometimes you may not be happy with the stamp duty value. If you are not happy with the stamp duty value, you are not happy with 150 lakhs. Now you have two options in life. Option number one. Option number one is you can go to the court and file a case against the state government. Today you have to pay tax as per 150 lakhs, but in future, if the state government reduces the stamp duty value, then the assessing officer will recompute your assessment order. Or if they increase the stamp duty value, then also they will recompute your assessment order, and that will be done within 4 years from the end of the financial year in which the court has passed the order. But this is not a very, very good option. The good option is second one. If you feel that the stamp duty value is too high, then you should go for second option. You should go to the assessing officer. The assessing officer will send you the departmental valuation officer. And the departmental valuation officer will determine your stamp duty value. And if the departmental valuation officer says that the stamp duty value is lower, it is 130 lakhs, then it will be 130 lakhs. If the departmental valuation officer says, no, it is not 130, it is not 150, it is 180, then it will be restricted to 150 lakhs. So if you refer the matter to valuation officer and if it goes to departmental valuation officer, it will not go beyond the stamp duty value declared earlier. Further, if the departmental valuation officer reduces the stamp duty value to 105 lakhs, then this section is not applicable only because the difference between 100 lakhs, the sale consideration, and 105 lakhs is not exceeding 110%. So all these three possibilities are over here. I hope it is clear to all of you. So better option is go to the departmental valuation officer, get it reduced. If it is reduced, great. If it doesn't reduce, it cannot increase more than the stamp duty value. Now, which date stamp duty value shall I take? Shall I take the stamp duty value on the date of agreement or shall I take the stamp duty value of future? That is the date of registration. You can take stamp duty value on the date of agreement if you fulfill two conditions. The amount has to be received. Advance has to be received on or before the date of agreement. Condition number one. You have to receive some advance on or before the date of agreement. Second, you have to receive the advance by 4 modes: account pay check, account pay draft, ECS, and such other electronic mode. If you fulfill these two conditions, you can take stamp duty value on the date of agreement, or else you have to take stamp duty value of future. If you don't receive advance on or before the date of agreement, but if you receive after, then you have to take future stamp duty value. Or if you receive the stamp duty, if you receive the advance on or before the date of agreement, but it is received by cross check or bearer check or cash, then you are violating the condition. You have to take the stamp duty value of future date. I hope it is clear. Last but not least, what if my property is not registered property? It is not a registered property, so how will the stamp duty value be determined? In that case, the law says that if your property is not registered, then assume that if you would have gone for registration, then what stamp duty value the authorities would have taken, that stamp duty value you have to take for the purpose of 50C. Check it, please. So even if it is not a registered property, you have to assume that if you would have gone for registration, then that what value they would have taken, that value will be called as what for the purpose of this chapter. I hope it is clear to all of you. Now coming to next section, 50CA. Sir, what is 50CA? It is transfer of unquoted shares. If you are selling unquoted shares, unlisted shares, then in that case, the FVC will be selling price or FMV of the unquoted shares, whichever is higher. The selling price will be what? FMV or actual selling price, whichever is higher, that will become your full value of consideration. There is only one exception for whom this section is not applicable. This section is not applicable if the NCLT has made an application. If the central government has made an application to NCLT to suspend board of directors, appoint new directors, and the shares so received in pursuant to resolution plan by NCLT, For in that case, this provision is not applicable. This section also comes in, this discussion also comes in section 79, which we'll see later on in the chapter of set off and carry forward. Now, what is 50D? 50D is a special provision where you say that I'm not able to determine my sale consideration. Suppose you sold your house and in return you have got some antique as a consideration for which you cannot compute. It is not possible to compute the value. It is not possible to value that particular asset. You have got something which is invaluable. You have got something which cannot be valued in terms of money. Then how will I determine the consideration? So in that case, 50D is relevant. 50D says that where the consideration is not ascertainable or cannot be determined, then the FMV of the said asset means the FMV of the house transferred. What you are transferring, not what you are getting. What you are getting, that FMV you cannot determine. So take the FMV of the asset which you are transferring. So whatever is the FMV on the date of transfer of the asset transferred, that will become the full value of consideration. I hope it is clear to all of you. Is it clear? Now let's move on to the next section, 50AA. 50AA covers 4 assets which will always be short term now. These 4 assets, the fate of these 4 assets are always short term. These 4 assets can never become long term. Which are these 4 unfortunate assets? First, if a specified mutual fund is acquired on or after 1st April 2023. Sir, what is a specified mutual fund? Specified mutual fund is nothing but a debt mutual fund in which more than 50-65% of the total money is invested in debt or money market instruments. So if more than 65% of the money is invested in the debt or money market instrument, it is called a specified mutual fund. And if a specified mutual fund is purchased on or after 2023, if it is purchased before 23, then it is not covered in 50AA. The date is important for mutual fund. Second, market linked debenture. Market linked debenture date is not relevant. If it is purchased before, then also it is covered in this section. If it is purchased today, then also it is covered in this section. Third, unlisted bond, unlisted debenture. For them also date is relevant if it is transferred or matured or redeemed on or after 23rd July. So be very careful. For mutual fund, you have to check when it is acquired. For market linked debenture, don't check anything. For unlisted debenture and unlisted bond, check if it is transferred on or after 23rd July. These 4 assets will always be short term. Always be short term, irrespective of the period of holding. Computation mechanism is same only. STT deduction not allowed, all those things same. But these 4 assets will always be called as what? As a short term capital asset. I hope it is clear. Let's move on to the one of the most important provision of this entire chapter. Nothing is more important than this section. In the entire capital gains, this is the most important provision, that is slum sale. So what is a slum sale? A slum sale is defined under section 2 clause 42C. What is slum sale, sir? Slum sale means transfer of an undertaking of a business. I have a business in which there are a lot of divisions. I am transferring one of the division for a lump sum consideration. I am not interested in individual calculations of the assets. I am transferring the entire unit, entire division of my business for one lump sum consideration without assigning individual values to any asset and liabilities. Yes, only for the purpose of stamp duty value, I will mention in the deed that the land stamp duty value is this much, the building stamp duty value is this much, because that is the state government requirement. Apart from land and building, I will not mention the value of any other assets and any other liability in my deed. Nothing will be mentioned. Everything will be for a lump sum basis. Okay. Sir, when a slum sale will be considered to be long term, I have told you earlier also. This is an only exception which will become long term after 36 months. If the undertaking is held for more than 36 months, it will be long term. If the undertaking is held up to 36 months, then it will be called as short term. Sir, how slum sale is computed? Same. Sale consideration minus cost of acquisition, which will be the net worth of the undertaking, that will make your long term or short term capital gains. First, we will see the cost and then we will see the sale consideration. Sir, how to compute the cost of acquisition? Cost of acquisition in case of slum sale is nothing but net worth of the undertaking. Sir, how to compute the net worth of the undertaking? For net worth, all the asset. Net worth is nothing but all assets minus all liabilities. Aggregate of total assets of the undertaking transfer. Whichever undertaking you are transferring, take the assets of that undertaking minus take the liabilities of that undertaking, and then the difference will be considered as net worth. For this purpose, all the assets are divided into 4 categories. First, depreciable asset will be valued as per the WDV as per the Income Tax Act. Income Tax Act 43 clause 6 WDV you have to take as per the Income Tax Act. If the asset transfer is 3580 asset, then you have to take nil. If the asset transfer is self-generated goodwill, you have to take nil. Other assets, you have to take book value. I hope it is clear. For liabilities, you have to take book values. Book value, book value, book value. For assets, don't take revaluation. Revaluation is not allowed. For contingent liabilities, do not take in the net worth. Only actual liability will come in the net worth. That too at book value. Contingent liability will not come in the net worth. I hope it is clear to all of you. Now, sir, this undertaking might have some losses, might have some UAD. Sir, that will also be transferred to the new undertaking? No, that will be continued to be carried forward and set up by the company itself. Okay, it will not be given to the transferee. It will be kept with the transferor only. Now, so how you will divide the assets? Four category. Depreciable asset, income tax WDV, 3580 nil, self-generated goodwill nil, any other asset book value. Liabilities book value. Then you take the difference, you will get the net worth. Now coming to what? Sale consideration. For sale consideration, the law has made one rule, Rule 11 UAE, and in that you have to compute two FMVs. FMV1, FMV2, whichever is higher. Whichever is higher, that FMV you have to take. Check here. As per Rule 11 UAE, FMV1 or FMV2, whichever is higher, for that they have prescribed the rule. Sir, what is FMV1? FMV1 is the FMV of the asset and the liability which we are transferring. Whatever we are transferring now, that asset's FMV is FMV1. Sir, what is FMV2? FMV2 is the value of the assets and what we are receiving. We might receive money, we might receive non-monetary consideration. Therefore, let's compute FMV1. Again, I am saying, what is FMV1? FMV1 is the asset and the liabilities that we are transferring. How to compute? A plus B plus C plus D minus L. A, B, C, D are asset, L is liability. Now, I will talk about B, C, D first. What is B? B is FMV of jewelry and artistic work based on valuation report. What is C? C is FMV of shares and security as per Rule 11 UA, which will come later on in IFRS. D is stamp duty value as per of the immobile property. So B cover jewelry and artistic work, you take FMV. C cover shares and security, you take FMV as per Rule 11 UA. And D cover stamp duty value, you take immobile property. Apart from that, all other assets will come in A. All. For all other assets, take book value. Other than jewelry and artistic work, already came. Other than shares and security, already came in C. Other than immobile property, already came in D. For rest all assets, take book value, but don't take two things. Do not take income tax. Do not take fictitious assets like miscellaneous expenses, preliminary expenses. Those are fictitious assets. Don't take that. I hope it is clear to all of you. Do not take those two things. Okay. I hope it is clear. Now, so B, C, D covers two assets, and then one asset, and then rest of the assets are covered in A, and in A they have removed two things, income tax and fictitious assets. What is liability? For A, B, C, D over now minus L. Liability, take book value of all liabilities, but do not take the following assets, following liabilities. First, do not take paid up capital. Do not take dividend amount set apart where such dividend have not been declared in the AGM before the date of transfer. Do not take reserves and surplus, but in reserves and surplus, take this, other than those set apart towards depreciation. This you have to take. This you have to take. Then don't take provision for tax. Then don't take uncertain liabilities. Then don't take contingent liability, but in contingent liability, take arrears of dividend in respect of cumulative preference shares. That you have to take. Arrears of dividend in case of cumulative preference shares, that you have to take for the purpose of calculation. This is your L. A plus B plus C plus D minus L. What are these values? These values are of the asset and liability that we are transferring. We are also using these items in calculation of our net worth. In net worth also we are using these calculations. Yes, the parameters might be different. The parameters might not be same everywhere. The parameters might be different. But in net worth also we are using these items. Now what is FMV2? FMV2 is the consideration that we are receiving. E plus F plus G plus H is FMV2. Sir, what is E? E is money. E is money that you are receiving. What is FGH? FGH is immovable property and other assets. What is F? F is FMV of non-monetary items referred in Rule 11 UA. So whatever items is mentioned in Rule 11 UA, compute as per Rule 11 UA. Point number G. What does G cover? G covers other than immobile property, because immobile property is covered in H, and other than assets covered in Rule 11 UA because that is covered in F. So G covers other than F and H. Whatever is not covered in F, whatever is not covered in H will come in G. For that you have to take FMV of assets. So it's very simple. E is money. F will cover FMV of those assets which are covered in Rule 11 UA. G will cover FMV of those assets which are not covered in Rule 11 UN and other than immovable property, because immovable property is covered in H. And for immovable property, you have to take stamp duty value. I hope it is clear to all of you. So this is how you will compute your FMV2. Once it is done, compare FMV1, FMV2, whichever is higher, that will be considered to be your what? Sale consideration. Now, let's go ahead with the next part. That is non-taxable transfer. Next part of capital gains. There are around 19-20 items which are considered to be non-taxable. I will come to that in a detail in some time. But before that, I have to say a few things. First, section 47. Any distribution of capital asset by HUF on partition. So, if the HUF on partition giving some assets to its members, it is not subject to tax. Second, if an asset is given as a gift, will or irrevocable trust, but only by individual and HUF, then it is exempt. If it is given by others, then it is taxable. Next, amalgamation, I will talk about that in later in detail in today's session only. Next, if an asset is given by holding company to subsidiary company, or if an asset is given by subsidiary company to holding company, it is fully exempt subject to two conditions. First of all, the holding subsidiary relationship has to be 100% holding subsidiary. Second, the recipient company has to be Indian company. If a holding is giving to subsidiary, then subsidiary should be Indian company, and the subsidiary is giving to holding, then the holding should be Indian company. If the recipient is Indian company, only then this benefit is available. Further, for the next 8 years, two conditions have to be fulfilled. Otherwise, whatever capital gain is exempt today, that will become taxable. 8 years, the transferee, the recipient company, should not convert the capital asset into stock in trade. 8 years, it should not convert into capital asset into stock in trade. Second, for 8 years, 100% holding relationship, subsidiary relationship has to be there. 100% holding subsidiary relationship should be there for a period of 8 years. If these conditions are fulfilled, capital gains will be exempt. Again, I am saying holding sending to a subsidiary, subsidiary sending to holding, the recipient has to be Indian company. And the relationship should be 100%. And for 8 years, they should not convert the capital asset into stock in trade. And for 8 years, they should not cease to be 100%. I hope it is clear. One last point I will say in a while in great detail in succession in 47, 13, 14 and 13b. Now, why I am saying all these things? I am saying all these things to not teach you section 47 now. Section 47 we will do in great detail now. Amalgamation is going to come in great detail. And demerger is going to come. Succession is going to come. All these things will come in great detail now. I am saying all these things to explain you section 49, cost of acquisition. I received an asset as a gift from my father. What is the cost of acquisition in my case? Cost to the previous owner. That is written in 49.1. My cost will be the cost to my father, cost of acquisition of the previous owner, cost of improvement of the previous owner, and cost of improvement of the current owner. These three costs will become my cost. If an asset is acquired by way of what? Gift, will, partition of HUF, amalgamation, demerger, succession, all these things. Holding subsidiary, subsidiary holding. So in the hands of the recipient, the cost will be the cost to the previous owner. What if the previous owner has also acquired by way of gift? My father has given the gift to my mother has given the gift to me. So in that case, I will take the cost of that previous owner who has paid the money from his pocket. So I will take the cost of acquisition of my father, not of my mother. I will not take the cost of acquisition of my mother. I will take the cost of acquisition of my father. I hope it is clear to all of you. Next, whether the asset is long-term or short-term, for that period of holding will be counted from where? My father has purchased in 2005. My father gave me in 2025. I sold in 2026. The period of holding will be counted from 2005 only. The period of holding will be clubbed as per explanation to section 242A. In case the asset is acquired by way of gift, will, etc., the period of holding of the previous owner shall also be included. It shall also be clubbed. Now coming to the most important point. Indexation I will get from where? My father purchased the asset in 2005. He gave me asset in 2022. I am selling in 2025. I will take indexation in the denominator of which year? If indexation is available. Indexation is anyways available only in one case now. So in this there are two options. As per Income Tax Act, you will take indexation in the denominator of the year in which you received the asset, that is of 2022. But as per the Bombay High Court judgment, in the case of Manjula Jesha, indexation has to be taken of the previous owner when your father acquired, that is 2005. So Manjula Jesha says that the indexation has to be taken of the previous owner. The income tax says that the indexation has to be taken of the current owner. What should we do in the examination? You can do both the things. You can write one answer and another answer as an alternate answer. That's what ICAI has been doing it. Next one. Very important case laws over here. RM Arunachalam Supreme Court. Aditya Kumar Jajodia Calcutta High Court. Very important judgment. What has happened in this case? There was an assessee who purchased what? Who purchased one property of 10 lakh rupees, for example. After that, he has taken a loan, he has mortgaged that property, he has taken a loan on that property of 8 lakh rupees. Now, after that, the father dies. So the son goes to the bank and says that, give my father's property. The bank says that, clear the loan and take your father's property. So the son cleared the father's loan and took the property. Now he is selling the property. So the question is whether the clearance of loan will also be considered a cost of acquisition. The court has said that yes, whatever loan is repaid by son for clearing the title, for clearing the encumbrance which is created by father, that is also a cost paid by the son, and therefore that will be allowed as deduction. So whenever you receive a property on which there is an encumbrance, and if you clear that title, that will be allowed as deduction. So one assessee by the name called as VSMR Jagdish Chandran, what he started doing? He started thinking like that. He bought a property, he took a loan, then he did not die. He himself wants to sell the property, so he cleared the loan and he is claiming the deduction. The court said no. The facts of the RM Arunachalam cannot be applied here. That was a very specific case where the property was acquired from someone else. Property was taken from someone else and there was an encumbrance. So moral of the story, if you have created the encumbrance, if you have disturbed the title and you are only clearing the title, you will not get the deduction. If somebody else has disturbed the title and you are clearing the title, that time you can claim the deduction under the income tax law. I hope it is clear to all of you. Now let's go ahead with the next part, which is a very big part, that is taxation of amalgamation. How amalgamation is treated under the income tax law. What do you mean by the term amalgamation? First of all, the term amalgamation is defined under section 21B. Sir, what is amalgamation? Amalgamation is nothing but merger of one company with another company, or merger of two or more company with another company, and they have to fulfill two conditions. Condition number one, all the properties and liabilities of the amalgamating company should be transferred to the amalgamated company. All properties of amalgamating company should be transferred to amalgamated company. Condition number one. Condition number two. Condition number two. At least 75% of the shareholders of the amalgamating company shall continue to become the shareholder of the amalgamated company. At least how much? At least 75% of the shareholders of the amalgamating company in value, not in head count, in value, should become the shareholder of the amalgamated company. If those two conditions are fulfilled, there are a lot of exemptions that are available for you, because if these two conditions are fulfilled, you are doing amalgamation. Now, what is the treatment in the hands of the shareholder? Let's take an example. There is A Limited over here. There is B Limited over here. This A Limited is amalgamating company. This B Limited is amalgamated company. Now, and I am a shareholder of this company. I am a shareholder of amalgamating company. So I have to give my shares back. So if I give my shares back and if I take the shares of B Limited, it is exempt. Give share, take share, exempt. Only one condition to fulfill, that is the amalgamated company should be Indian company. So if I give share and take share, it is exempt. If I give share and take money, it is taxable. But only condition for exemption is the amalgamated company should be Indian company. First point. Second, so I gave the share of amalgamating company, I took the share of amalgamated company, it is exempt. In future, if I sell the shares of amalgamated company, the cost will be same as the cost of amalgamating company shares. The cost of acquisition of the shares in the amalgamated company will be same as the cost of acquisition of the shares in the amalgamating company, and the period of holding will also be clubbed. The period of holding will also be counted from the date on which you purchase the shares in amalgamating company. From that date, we will count the period of holding also. Now, one last thing over here is very important. It is one last thing very important. Pay absolute attention. Suppose B Limited already holds shares in A Limited. B Limited is already a shareholder of A Limited. So B Limited will return the shares of A Limited, and in return, B Limited cannot give its own share to itself. So in that case, they can give money to themselves. That's the reason they have written, except where the shareholder itself is the amalgamated company. If the shareholder itself is the amalgamated company, then they don't have to give their own shares to themselves. In that case, they can adjust in money. Let's move on to the second part now. What is the treatment in the hands of amalgamating company? Amalgamating company A Limited will transfer a lot of capital assets to amalgamated company. All of them are exempt, subject to only one condition, that the amalgamated company should be an Indian company. If the amalgamated company is an Indian company, all assets transferred from here to there are fully exempt. Next discussion, amalgamation of foreign companies. For that, we need to understand one example over here. This is India. There is A Limited here. There is XINC, which is in USA. There is YINC, which is in UK. And this this foreign company holds some shares in Indian company. Now, suppose XINC is getting amalgamated with YINC. XINC is amalgamating company. YINC is amalgamated company. Suppose XINC is getting amalgamated with YINC. So they are transferring the shares of Indian company. Will this be exempt? Yes, this will be exempt subject to two conditions. First, 25% of the shareholders of the XINC. Now, 25% of the shareholders in number, not in value. 25% of the shareholders of XINC should continue to become the shareholders of YINC. Condition number one. Condition number two. Such transaction should not be taxable in XINC country, that is in USA. That is the country in which the amalgamating company is incorporated. So in whichever country amalgamating company is incorporated, in that country such transaction should not be taxable. If you are not levying tax, we will also not levy tax. If you are levying tax, then we will also levy tax. Then the matter will resolve through DTAA. The home country should give you advantage now of amalgamation. If the home country is not interested in giving you amalgamation advantage, then why will we give you amalgamation advantage unnecessarily? We are also not going to give you. Get lost from here. Now we will talk about one of the biggest advantage of amalgamation is when amalgamation is done, you are allowed to carry forward the losses and UAD of the amalgamating company in the hands of the amalgamated company. For that, there is a separate section 72A. 72A is applicable for amalgamation, demerger and succession, all three of them. First of all, amalgamation losses cannot be transferred by all businesses. Only certain specified businesses can transfer the losses. See, amalgamation capital gain exemptions can be enjoyed by every person. Capital gain exemption can be enjoyed by every company, but losses exemptions, losses carry forward is only enjoyed by these people. Who are these fortunate people? If there is an amalgamation of a company owning an industrial undertaking. Sir, what do you mean by industrial undertaking? That is defined below. It means you should be engaged in manufacturing or processing of goods or manufacturing of computer software. Or you should be engaged in generation or distribution of electricity or power, or you should be engaged in telecommunication services, including radio paging, satellite service, network trunking, broadband network, internet service, or you should be engaged in mining, or you should be engaged in construction of ship, aircraft or rail system. All these things are considered as what? Industrial undertaking. This we are learning not for exemption. This we are learning for carry forward of losses. Or if you are engaged in the business of shipping or hotel and you are doing amalgamation with another company. Or if there is an amalgamation of banking company with a specified bank. Or if there is an amalgamation of public sector company with another public sector company. Or if there is a disinvestment. If there is a strategic disinvestment, this came for Air India. If there is a strategic disinvestment which is carried out within 5 years. Sir, what is disinvestment? Where Air India, which was owned by government, it is sold to private player Tata. Now, what is disinvestment? Disinvestment means sale of shareholding by central government, state government, public sector company, which results in reduction of shareholding below 15% and transferring the control to the buyer. That is disinvestments. So all these people are eligible for what? Carry forward of losses. Now. Only these are the assessees who are eligible for carry forward of losses in case of amalgamation. Capital gain exemption is available for everybody. Capital gain exemptions have nothing to do with these people. These people are only eligible to carry forward the losses also, along with capital gain exemption. Now, if you want to carry forward the losses, the amalgamating company has to fulfill two conditions. An amalgamated company has to fulfill three conditions. Amalgamating company will fulfill 2 and amalgamated company will fulfill 3 conditions. Total 5 conditions have to be fulfilled. What conditions amalgamating company has to fulfill? First, the business has to be at least 3 years older. The business which is getting amalgamated, the company which is getting amalgamated, it has to be at least 3 years older. First. Second, 2 years back, whatever book value of fixed assets were held by the company, of that at least 75% should be held today. 2 years back, today is the date of amalgamation. Go 2 years back, check the fixed asset register, find out the fixed asset, find out the value. And at least 75% of the book value of that asset should be there today also in your books of accounts, in your fixed asset register. If these two conditions are fulfilled, the conditions of amalgamating company are fulfilled. Now you have to fulfill some conditions for amalgamated company. Amalgamated company conditions are future conditions. Amalgamating company conditions are past conditions. Now, amalgamated company has to fulfill 3 conditions. First, the business should be continued for at least 5 years. Second, whatever assets they have received. Point number 3 I am saying first. Then I will come to point number 2. Point number 2 is not applicable for everyone. Point number 2 is only applicable to industrial undertaking. Third point. Whatever assets you have received, fixed assets you have received today, 5 years later, at least 75% of the book value of the asset you should hold. So after 5 years, the assessing officer will send you a notice and check the data. So you should have that much, at least 75% of the book value of fixed assets you should have after 5 years. And second condition is only for industrial undertaking. It is not for everybody. So in that too, that is only applicable for manufacturing assessee. So if you are doing manufacturing and if you are purchasing a company, if you are doing an amalgamation with another company and you are taking their installed capacity, you should achieve at least 50% of the total capacity till the end of 4th year. And the 5th year, you have to maintain that much. Suppose the installed capacity of the company is 1 lakh unit and you are acquiring that company in the form of amalgamation. So by the end of 4th year, you should achieve at least 50% of the total capacity, at least 50,000 units you should be able to manufacture. And in the 5th year, you have to maintain that. The government, if required, they may relax the period, they may relax the percentage also. Relaxing the period means they will increase the period. Relaxing the percentage means they will reduce the percentage from 50 to 40, 30, whatever they want to, depending upon the circumstances. Now, some disadvantages. In amalgamation, till last year, the amalgamated company was allowed to carry forward the losses for another 8 years. Now only for balance years, not another 8 years. For demerger, it was balanced earlier also. Now also it is earlier. In demerger, there is no amendment. For conversion of firm or proprietor into company, here also amendment has come. It was another 8 years. Now it has become balance 8 years. This is the disadvantage. For conversion of unlisted or private company into LLP, here also it was another 8 years. But from 1st April 2025, it is balance 8 years. So in amalgamation and succession, amendment has come. In demerger, already the provision was like that only earlier also. For UID, there is no restriction. For UID, you can carry forward for infinite number of years. Now the question, which losses you have to carry forward? You have to carry forward only non-speculation business loss covered under section 72, not non-speculation loss. Only non-speculation business loss will be allowed to carry forward. All losses are not allowed. Only non-speculation business losses are allowed to carry forward under the income tax law. Okay. Again, I am saying, these conditions which we have done 972A, these are only for carry forward and set off of losses, and these have nothing to do with exemption under 47. For exemption under section 47, you have to just fulfill the basic conditions. That's it. Now, if you violate any condition in future, then whatever losses you have set off, whatever you have set off, that will become deemed income of the assessee, of the amalgamated company. Like you have closed the business within 5 years, or you're not able to achieve the installed capacity, or you're not able to maintain 75% of the book value of the fixed asset after 5 years, then whatever losses you have set off or UID you have set off, that will become deemed income. Okay. Now coming to the taxation in the hands of the amalgamated company. What is the treatment in the hands of amalgamated company? The amalgamating company has transferred all the assets to amalgamated company. Now in future, amalgamated company will sell those assets. So they will ask what will be the cost. The cost will be the cost to the previous owner. Period of holding will be clubbed. The cost will be counted as if it is purchased there. So I am amalgamated company, you are amalgamating company. Whatever cost you have incurred for purchasing an asset, that will become my cost. Period of holding I will count from there. Now from point number 4 to point number 11, I have put all the PGBP provisions over here, which has an impact in amalgamation. Like expenditure on scientific research. If you have purchased a scientific research asset And if you are transferring that in amalgamation, is that also exempt? Yes, that is also exempt. Then, if there is unabsorbed capital expenditure of scientific research, which is treated like UID, can that also be carried forward by amalgamated company? Yes, that can also be carried forward by amalgamated company. It is allowed. Then, later on, the asset which is transferred to amalgamated company, if they sell the asset, they are also supposed to bear the brunt of deemed income. Yes, deemed income under 41(1), X 41(3), etc. They also have to bear the brunt of deemed income. Next, telecom license fees paid. 35 ABB telecom license fees paid. 35 ABA is the spectrum license fees paid. So such license transfer is also not taxable. That is also exempt. Such deduction will also be available for balance number of years to amalgamated company. Amalgamated company can enjoy for the, because telecom license deduction is allowed over the life of the license. Suppose the life of the license is 10 years and the amalgamation happened in 5th year. So for the balance number of years, amalgamated company will be eligible to get the benefit. Similarly, if the amalgamated company sells the telecom license, they are liable to pay tax on that, deemed income, whatever capital gains, etc. they have to pay. Then preliminary expense, 35D, allowed in 5 years. It will be allowed to amalgamated company for the balance years. Similarly, amalgamation expense 35DD. This is also allowed in 5 equal installments. This will also be allowed to the amalgamated company for balance number of years. Similarly, capital expenditure of family planning. Remember, capital expenditure of family planning is also allowed over 5 years. So this will also be allowed for balance number of years to the amalgamated company. Plus, here also, if a loss happens because of capital expenditure of family planning, that is treated like UAD, that will also be transferred to the amalgamated company. They can transfer, they can take that also and set off against their income. Next, 35 DDA, VRS. VRS is also allowed in 5 years. That will also balance VRS will be allowed to the amalgamated company. Taxation of mine 35E. This is also allowed over life of 10 years. It is allowed over 10 years. So this will also be allowed. Balance number of years will be allowed to the amalgamated company. Next, bad debts. Goods are sold by amalgamating company. Goods are sold by amalgamating company. But it has become bad in the hands of amalgamated company. Therefore, it will be considered as bad debts in the hands of amalgamated company. Amalgamated company can claim deduction as per the Supreme Court judgment of T. Veerabhadra Rao K. Koteshwara Rao. We have done all these things in our class in PGPP. Then, expenses incurred by amalgamating company, but it is recovered by amalgamated company. Yes, it is deemed income. Electricity expenses incurred by amalgamating company, but it is recovered by amalgamated company. It is deemed income in the hands of the recipient. Next, recovery of bad debts is not taxable as per Supreme Court judgment of P.K. Kemal. If bad debts is claimed by amalgamating company and it is recovered by amalgamated company, it is not taxable in the hands of amalgamated company. Next, a very famous provision in case of amalgamation, demerger, succession, compute depreciation, as if no amalgamation, no demerger, no succession has taken place, and then apportion the depreciation between both of them on the basis of number of days the assets are used by them. Next, whatever depreciable assets are coming from there, the WDV in the hands of the amalgamating company will become the cost in the hands of the amalgamated company, and the amalgamated company can claim depreciation on that in future. Now, one common point which is given under point number 5, 6, 7, 8, 9, 10. These 6 points. What are these 6 points? Check. These 6 points are nothing but amortization. So, in case of amortization, the doubt will come. Till last year, amalgamating company will claim. From next year, amalgamated company will claim. Who will claim in the current year? In current year, entire amount will be claimed by the amalgamated company. No bifurcation. In the current year, you don't have to do any bifurcation. Entire amount will be claimed by whom? It will be claimed by the amalgamated company only. Entire amount will be claimed by amalgamated company. But later on, one section will come, 44 DB, where in the current year also you have to apportion on the basis of number of days. But here, in the current year, you don't have to apportion. Only depreciation you have to apportion on the basis of number of days. Apart from depreciation, all other amortizations, current year fully will be given to the amalgamated company. I hope it is clear to all of you. Now, next one is also related to amalgamation. Suppose in amalgamation, I am amalgamated company, you are amalgamating company, and you are giving me SIT, stock in trade. And later on, if I want to sell that of stock in trade, so what will be the cost of that stock in trade? So the cost of that stock in trade is given in 43C. So if I am an amalgamated company, you are an amalgamating company, and you are giving me what? SIT. And later on, I am selling that SIT. So my cost will be your cost. As simple as that. My cost will be your cost, Your improvement will be my improvement and my improvement will also be my improvement. As simple as that. This logic will also be applicable in case of gift, will, partition of HUF, etc. My father has given me gift as SIT, has given a gift as SIT. I want to sell that SIT. What will be the cost under PGBP? I cannot apply 49.1 at that time. 49.1 is only for capital gains. 49.1 is not for PGBP. Therefore, what will be the cost in that case? The cost in that case will be the cost to my father. As simple as that. As per which section? As per section 43C. I hope it is clear to all of you. Now, let's move on to some small exemptions under section 47. One by one, we will see that over here. First one, if you transfer any work of art, archaeological collection, scientific or art collection, book, manuscript, drawing, painting, photography, print, to whom? To whom? To whom? To whom? To whom? We are transferring all these things to whom? These are all artwork. You are transferring to government, not to normal people. You are transferring to university, national museum, national art gallery, national archives, or other institution or any public museum which is notified by central government. If you are transferring these items to these people, certain art items you are transferring to certain governmental people and museums, then it is exempt under section 47(9). I hope it is clear to all of you. Next one, sovereign gold bond. Sovereign gold bond is exempt for individuals provided they transfer on redemption, on maturity. So if a sovereign gold bond is transferred on maturity by individual, it is exempt. What about if it is transferred before redemption? Then it is taxable. What about if it is transferred by other than individual? Then it is always taxable. Only for individuals it is exempt, that too if they redeem if they mature. If they transfer before that, taxable. For others it is always taxable. I hope it is clear to all of you. Next one, 47(7)(b). In 47(7)(b) there are a lot of conditions. One by one I will say. If one non-resident transfers to another non-resident outside India government security which carries periodic interest and it is transferred through intermediary, a broker. If these conditions are fulfilled, then it is exempt. Who is transferring? NR. To whom it is transferring? Another NR. What is transferring? Government security. Which kind of government security? Periodic payment interest government security. Where he is transferring? Outside India. How is transferring? Through intermediary. If these 6 conditions are fulfilled, it is exempt. I hope it is clear to all of you. Next one. I have physical gold. I want electronic gold. So I went to the bank. I gave physical gold. I took electronic gold. Exempt. I have electronic gold. I want physical gold. So I gave electronic gold. I took physical gold in the bank. Exempt. Vice versa, exempt. Give physical gold, take electronic gold receipt, or give electronic gold receipt, take physical gold. Exempt. Later on when I will sell, only conversion is exempt. Sale is not exempt. Later on when I will sell, what will be the cost? The cost of the physical gold will be the cost of the EGR. Period of holding will be club. Check. Very simple. The cost of the physical gold will be the cost of the EGR and the period of holding will be club. Next one, 47(10). I am converting my bond, debenture stock or deposit certificate. 4 items. Bond, debenture stock, deposit certificate into what? Into shares or debentures of that company, it is exempt. So you are a company, I have a bond of your company. I gave the bond, I took the shares, exempt. I gave the bond, I took the debenture, exempt. Later on, whenever I will sell the shares, the cost of acquisition will be, the cost of shares will be the cost of the bonds. Period of holding will be clubbed. It is same only everywhere. I don't have to say this again and again. Similarly, next point, conversion of preference shares into equity shares, same, conversion is exempt. Later on, when you will sell the equity share, that is taxable. Conversion of preference shares into equity shares is exempt, but when you will sell the equity share, that will be taxable. Okay. So what will be the cost of acquisition of equity share? The cost of acquisition of the equity shares will be same as what? The cost of acquisition of the preference shares. Period of holding will be clubbed. As simple as that. Check it, please. Next one, 47(12). If your company has become an sick industrial company, your company has become what? Sick industry. And because of that, you are transferring your land. So whatever land you are transferring on becoming sick, that will not be subject to tax. That will be exempt under income tax law. Next one, reverse mortgage scheme. Suppose I am a senior citizen, I am going to bank and I am mortgaging my property and telling the bank, please take my property, give me monthly income. This is how reverse mortgage scheme runs. Go to the bank, you are a senior citizen, go to the bank, give the property and take in return what? Take in return some income. So whatever property I have transferred in reverse mortgage, that is exempt under section 47(16). And in return, whatever money you will receive, that is also exempt. Whatever money, installment or lump sum, whatever you will receive, that is also exempt under section 1043. That is also not subject to tax. I hope it is clear to all of you. So I will take a break for 5 minutes, and after that I will continue. Okay. Till then, you please comment here. How is the revision going on? Please, all of you, give your opinion. Don't worry like that. I will put the entire syllabus. I will take like this. Don't worry. After that, I will take the MCQ videos also for you all, which ICI has put in English. That also I will take. What I will do, I will stop the session here. We will take 2 hour session every day. It means every alternate date, and day after tomorrow on Sunday we will complete capital gains. Okay. Because now fast is going on, I am not able to speak because I am not able to drink water.